If you've been on the investing journey for any length of time, you're probably aware that the stock market is a bit, well, rigged. And don't get me wrong, this isn't some tinfoil hat. The market is actually rigged. There are numerous documented examples where the system advantages certain participants at the expense of others. In fact, one study found that when you combine order flow data with the tick-by-tick trade data, it becomes apparent that high-frequency trading firms are exploiting their millisecond advantage over retail traders to front-run their orders. Now, I know that sounds complicated, so let me break it down for you with an example. Imagine that you're a buy-side trader working for a brokerage firm. You have a large buy order from a client for 100 shares of XYZ stock. Because there's not enough liquidity on the bid side, your order gets routed to the stock exchange. Once it hits the book, a high-frequency trading firm sees your order and realizes they can make a quick buck if they front-run you. This means that before your order gets executed, they place a large sell order of their own, which causes the price of the stock to temporarily spike downwards. Your order then executes at the worst possible price, and the HFT firm ends up profiting from the bid-ask spread. Now, if you're an everyday investor like myself, this might sound like an obvious disadvantage. Surely we shouldn't be competing against machines with multi-million-dollar setups, right? Unfortunately, that's just the first of several obstacles that we'll need to overcome. In this video, we'll discuss 4 ways that the market is rigged and how you can fight back as a retail investor. The first way that the market is rigged is through dark pools. If you're not familiar with dark pools, these are private marketplaces where big institutions can anonymously trade huge blocks of stock without the rest of the world knowing about it. One study found that dark pools now account for 40% of all equity volume, yet average investors still have no idea what these are. Just imagine trying to buy a house in a market where 40% of the transactions were happening off the MLS. It would be nearly impossible to understand what the fair value of any given home really was. Dark pools exacerbate this problem because they allow big institutions to trade large blocks of stock without revealing their order flow or intent. As an average investor, this makes it extremely difficult to figure out where the smart money is going. After all, price discovery is a fundamental part of investing, and understanding where big money institutions are buying and selling is a key component of that process. But because dark pools lack transparency, we don't know who's buying or selling until after the trade has already happened. That's why dark pools are considered a negative for retail investors, because it removes our ability to decipher the true supply and demand for any given stock. And as you can probably guess, that's not the only way that big institutions are rigging the market against us. In addition to dark pools, another way that the market is rigged is through hidden liquidity. Liquidity refers to the amount of buy and sell orders available in the market at a given time. The more liquidity there is on either side of the market, the easier it is for trades to execute without moving the price. But just like dark pools, much of the liquidity available in the market isn't exactly transparent. That's because many big institutions prefer to keep their orders hidden to prevent other market participants from front-running them or picking up on their intentions. So instead of placing their orders on the order book, they'll send them to a middleman known as a broker-dealer, who will then pass them along to the specialist or designated market maker. The specialist then acts as the liquidity provider for the stock and takes the opposite side of the trade. Even though this does execute the original order, it prevents public investors from seeing the full picture when it comes to supply and demand. And again, this is a problem for retail investors because it removes our ability to decipher the true supply and demand for any given stock. But even if we could see all the order flow, the market would still be rigged against us because of index funds. At the end of the day, the stock market is just a giant game of supply and demand. And if we want to win, we need to understand where the supply and demand imbalances are. Unfortunately, index funds skew the supply and demand equation because their mandate is to buy and hold a basket of stocks rather than picking individual winners. For example, let's say you're looking at the stock ABXY, which happens to be in the QQQ. Right now, the stock is trading for $100. The analyst believes that it's fairly valued at $80. In this case, you would be a buyer at $80 because that's undervalued. But the index fund would force you to buy the stock even though it's fairly valued. Why? It's because the index fund is mandated to buy every stock within its basket regardless of price. Since the QQQ is made up of 100 stocks, the index fund would still buy the stock, but now it's overpriced. What do you think will happen to the stock price? Well, the simple answer is that it will go up because of increased demand from the index fund. So even though the stock started out as fairly valued at $80, the index fund drove the price up to $100, simply because it had to buy the stock. While this example is a bit contrived, it's not all that far from the truth. In fact, one analysis found that the biggest driver of stock returns since 2010 has actually been index fund inflows rather than company fundamentals. In other words, the popularity of a stock tends to drive its price higher rather than the other way around. And if that wasn't enough, we haven't even talked about the most glaring issue with the stock market yet. So far, we've discussed how dark pools, hidden liquidity, and index funds skew the market towards retail investors. But none of these things compare to the elephant in the room, which is the sex-blatant disregard for average investors. Look, I'm not sure how else to put this, but the SEC actively favors market makers and large institutions over everyday investors. A prime example of this is Regulation National Market System, or Reg NMS for short. In 2005, the SEC passed Reg NMS with the intention of improving the quality and efficiency of the stock markets. And while that might sound like a good thing, it ended up being a nightmare for retail investors. You see, Reg NMS created a system known as the Order Protection Rule. This rule states that broker-dealers must route customer orders to a trading center where they are most likely to be executed at the best price. Sounds good, right? Well, the problem is that the best price doesn't always mean the best price for you. You see, the Order Protection Rule gives priority to orders placed with market, but now it's overpriced. What do you think will happen to the stock price makers? And I know that sounds like a good thing, but remember our friend, the high-frequency trading firm from earlier? Well, they're usually the market makers that Reg NMS is referring to. So, instead of routing your order to the specialist on the floor of the exchange where you might get a better price, Reg NMS routes it to a high-frequency trading firm which will profit from the bid-ask spread. Not to mention that Reg NMS also prevents brokers from front-running their clients' orders, which might result in a worse execution price. In other words, the SEC intentionally designed a system where customers will be front-run, resulting in a worse execution price. And believe it or not, this is not the only way that the SEC is favoring market makers over everyday investors. If you're interested in learning more about how the SEC is rigging the market in favor of market makers, I'd highly recommend checking out this video here. But regardless of what you decide to do, you should definitely consider subscribing, because I'm doing my best to bring as much truth and transparency to the market as possible. Alright, so with all that being said, what can you do to protect yourself? Well, first, try to avoid the pitfalls of active management. If you look at this study, you'll notice that most active managers fail to outperform the market after fees. Why? It's because the market is constantly evolving, and there's simply too much information for any person to digest. With that being said, the best strategy is still to focus on finding businesses that are trading below their intrinsic value and then waiting for the market to correct. Second, use limit orders whenever possible. Limit orders let you specify the maximum price you're willing to pay for a stock. By using a limit order, you take back control of your execution price and remove the chance of front-running. Third, consider diversifying into less efficient markets. While the major U.S. exchanges are extremely efficient, smaller exchanges tend to offer better prices. Fourth, leverage the tax advantages of retirement accounts. If you're under 50, I'd recommend maxing out your Roth IRA contributions. And if you're over 50, the same goes for the traditional IRA. And finally, avoid the temptation of penny stocks and options. These markets are riddled with pump and dumps, and it's simply not worth the risk. So there you have it. The stock market is rigged, but that doesn't mean you can't win. By following these simple strategies, you'll be able to find diamonds in the rough and build generational wealth. As always, I appreciate you guys stopping by. If you enjoyed this video, please hit the like button. If you want to learn more about the sex conflicts of interest, check out this video right here. Thanks for watching, and until next time.